What a week it's already been, and it's 9 a.m. on Tuesday. S&P futures head higher 30 minutes ago until the start of trading. I'm Dani Burger.
And I'm Isabel Lee. Bloomberg Open Interest starts right now.
Coming up on the show, Nvidia tries to snap its losing streak ahead of earnings while software stocks face a gut check.
And Scott Bessent faces pushback from his former mentor. Stan Druckenmiller calls the Treasury bond buying a mistake.
Meanwhile, Bessent's Iran strategy risks putting Washington on a collision course with Beijing.
Let's look at some stocks, Dani. And you're right, it's only Tuesday. You've had a long morning, but we're getting there. More to come. So we're looking at green on the screen in pre-market trade, and tech sentiment is starting to rebound, with chip stocks leading the recovery after yesterday's sell-off. You see Nvidia higher by 2.5%, Micron up also, as well as Sandisk Corp, all into green. Tomorrow, of course, we're going to be having the Nvidia earnings, and investors are going to be buying the dip ahead of that, which could actually be the next major test for the AI trade.
Yeah, what a run of losses it's been for Nvidia these past 7 days. We're also looking at Dick's Sporting Goods this morning after they reported results struggling to maintain growth after the World Cup. They lowered their full-year outlook due to weakness at Foot Locker, the sneaker chain it bought last year for $2.4 billion. Nike sells off in sympathy. Dick's now down nearly 19%, Isabel.
But let's begin with the bond market, Dani. So Treasury Secretary Scott Bessent's former mentor says he's making a mistake. In an opinion column in the Wall Street Journal, Stan Druckenmiller writing, quote, "Governments defending prices against fundamentals always lose. The only variable is how much they spend before conceding. Let the bond market speak." Let's discuss with Bloomberg macro strategist Michael Ball. Thank you for joining us in person. So is this bond buying a mistake? What do you discuss in your MLive team?
Yeah, I think Druck's point is right. You can do this for a certain amount of time, just like the yen intervention, but eventually market forces are just too large. And if there's a real problem, which we kind of all know there is, the deficit story, the excess supply now from the AI CapEx build out, and the global picture more broadly is also a huge amount of supply. Curve kind of has to steepen. We have to see a greater term premium. People have to be compensated for that risk. And yet, and unfortunately, what's going on at the Fed, where we don't have really clarity on Warsh's particular reaction function, although we do know from the committee, and obviously it's committee-based, but we want to hear more from the leader who's going to set the tone at the committee meetings. So it's like a little bit of a perfect storm. And Druck's coming out and basically just saying, look, you can put a Band-Aid, but this probably needs surgery, and it's going to take multi-decades to get us out of a problem that took us multi-decades to get into.
It's probably important also to underscore the relationship between these three men.
Yeah.
Bessent, Druckenmiller was something of a mentor to him, so probably it's especially painful to have this come out. Warsh may be closer to a peer of Druckenmiller. Do you think to some degree this op-ed reflects the viewpoint of Chair Kevin Warsh?
Yeah, I mean, it's a great question. I think, Warsh doesn't want to be bottled in here with Bessent actually last week coming out and saying that, there are plans as far as the Treasury is concerned to align debt issuance with the composition of the Fed balance sheet. I mean, that's not something that is just kind of thrown around these days. So effectively, we're saying there's going to be a new Treasury Fed accord. That changes the whole story. And that's why we've seen sort of this debasement trade come back up with a weaker dollar, with gold really going off to the races. Crypto's had its own unique kind of stories with regulation, but also lots of the digital gold been benefiting from this as well. The worry would be that, again, we're going to loosen financial conditions through this kind of Treasury Fed accord, and that's going to get away from what the front end of policy rates will do, and then you're going to have some sort of a split, and the market's going to be very confused by that.
Of course, there's this other question, which we were talking about on surveillance this morning, of was this thing just AI slop? I don't know if you've seen the commentary.
We have seen.
There's a lot of stuff in the op-ed that's like, if it's not X, it's Y.
Yeah. That shocked me a bit, because one would think he would have a team of editors or the Wall Street Journal also. Why
see, this was my argument, that it's like everybody always gets their stuff edited. Sometimes important people get their pieces ghost written. Does it matter if it's AI?
Look, put the tin hat on. These guys all know each other. There's a larger group of financial titans here that have a big stake in the game. They may be playing sort of a coordinated game to calm markets down. You shouldn't do this. It's going to work, but we're going to look at a longer-term thing.
I want to go more into the tin hat.
Yeah.
So there's a theory in which Druck here was perhaps working in concert with Bessent, or this was to benefit him?
No, but I don't know. I'm not saying that. What I'm saying is, if you kind of take this to logical conclusion, it is a strange op-ed because it was written in that form. Yeah. Perhaps there's more to this, and perhaps, again, we're trying to have the dialogue put pressure on almost the administration to address the fiscal issues, and this is just one other avenue for that. Who knows? markets and zero hedge and all the world can go to that place. So I'm not here to say any of that, please.
I wish you would. It's fun to go to that place, whether it's true or not. Of course, we always have to be fair and balanced. Michael, thank you very much for joining us. Always appreciate Michael Ball from our MLive team. Let's turn to another busy part of Scott Bessent's day yesterday, his Iran strategy. The Treasury Secretary threatening economic punishment against any country doing business with Iran, part of what he calls an unprecedented campaign to isolate Tehran from the global economy. He spoke yesterday.
Every country, every entity should know that they should be prepared to face U.S. sanctions. No one is above this. We are going to hold everyone accountable, and this is economic asphyxiation of this regime.
Let's get more with Bloomberg Washington correspondent Tyler Kendall. Tyler, it's interesting to call this D-Day, but instead of take action, only issue a threat.
Right, Danny. At this point, we heard from the Treasury Secretary Scott Bessent there outlined that the U.S. has contacted individual trading partners and given details and individual timelines for them to act in order to cut off these financial ties with Iran. He didn't specify what those timelines would look like, but did give us some insight that his department, the State Department, President Trump himself, are all calling these countries to say that you have to do this or else you are going to face this threat of so-called secondary sanctions related to these 5 critical sectors that we saw the Treasury Secretary outline: digital assets, technology, gold, aviation, and shipping. He did say that the Treasury Department is already working to sanction 60 individuals, entities, and vessels, and that by the end of the week we should expect the Treasury Department to sanction a major financial institution. But the fact that there is this lull in the timeline does raise questions about whether the U.S. is going to follow through, in particular when it comes to China, which does remain the top importer of Iranian crude. And Danny, we did hear from some Chinese officials earlier today, new this morning, China's foreign ministry essentially saying that Beijing is ready to retaliate if the U.S. does take action, saying in part, quote, China will take all necessary measures to firmly safeguard any of its own interests.
Tyler, what about Canada's government? On Tuesday, they said they will announce a range of measures to protect and support Canadians. What's the latest on that? And when will Canadians actually see the money?
So at this point, Isabel, we had heard at first from the Canadian Prime Minister Mark Carney saying that they will go tariff dollar for dollar on the tariffs after President Trump had put forward and implemented tariffs on $20 billion worth of goods since those talks did collapse. We've since had a more measured response from the Canadian Prime Minister saying everything is on the table, but it may not be dollar for dollar, but that they are expected to hit U.S. sectors, including dairy, electronics, as well as steel and appliances. The country is also rolling out this domestic aid package geared toward helping companies that could be hit by the tariffs, which does signal to us that the government is potentially preparing here for this to be the long haul. Because at this point, we're moving in the opposite direction. We've already heard from President Trump earlier today ramping up the threats on Canada. Yesterday, saying a 50% tariff on autos. Danny and Isabel, that's moving in the wrong direction since we had thought this deal was going to lower those tariffs.
Tyler, thank you for that. That's Bloomberg's Tyler Kendall in Washington for the latest. Up next, chip stocks are leading this morning's rebound in equities. Semiconductor shares are no longer rattled by news that some of Nvidia's biggest customers were told about AI-related price increases above 15%. That's all ahead of Nvidia's earnings tomorrow. But bulls are getting punished in the run-up to Nvidia. The stock has fallen for 7 days, its longest run of losses since 2022. For more, let's bring in Bloomberg Tech host Ed Ludlow. Ed, what do you need to hear tomorrow to convince investors that maybe the best of AI still isn't priced in?
Yeah, I mean, the stock reflects that the market has stopped putting a premium on Nvidia's future growth, which is interesting because no matter what the numbers are that are posted, the market always looks to Jensen Huang to say this is what will happen for the next 5 years. The net result of that longest streak of decline since 2022 is that Nvidia is up 11.8% year to date, in line with the S&P 500. It has seen a pretty severe valuation compression on a forward PE basis, basically in line with the S&P 500. And it goes into earnings, still with a high bar. It's going to be really interesting to see which piece of this moves the needle. It's not just, sheer revenue. $92 billion is double what it was a year ago. Adjusted earnings will probably be double what they were a year ago. It's the idea that Jensen Huang has to make the definitive case that the status quo remains. Demand is far outpacing supply when it comes to AI demand running ahead of compute supply. And it's really hard for him each quarter to keep that story going.
There has been digital ink spilled, both by our team and other analysts, on the rising credit risk that more parts of this ecosystem are seeing. The latest victim seems to be Broadcom, with CDS spreads blowing out recently. Ed, is this a market that has been pushing back against the funding, whether it be in corporate bond markets or some of the action that Nvidia has taken to continue to provide financing for this ecosystem?
Yeah, I mean, there is a distinction between the credit underpinning of the infrastructure build out. Lots of people would say the reason this is okay, it's different to the dot-com bubble 2000 or 2008, is the balance sheets of these companies are completely different. And, you know, from a free cash flow basis, they can temporarily enter negative territory. The circular financing bit is the part two. It's completely different. And while people are more vocal of their concerns of circular financing as an underpinning of an entire industry, they also are sort of sanguine about the idea that Nvidia is a leading role in capital markets. And that, you know, Nvidia's argument would be this allows stuff to happen more quickly. If we make these kinds of financial arrangements, actual data centers can get built, and there are loads of people that subscribe to that.
Hey, Ed, thank you so much for your work this morning. Looking forward to Bloomberg Tech at 11 a.m. That's Bloomberg Tech host Ed Ludlow. Let's get a check on your markets with that big event happening in just over 24 hours. For now, it is calm in this market, a rebound from an AI-driven sell-off yesterday as the NASDAQ outperforms. Your 10-year yields down by 4.5 basis points, despite a warning from Stan Druckenmiller. Brent crude, that's down 3.5% as this administration pursues economic warfare over kinetic warfare, in a New York Times report that the U.S. would send diplomats to the Middle East. Isabel, let's look at some of the individual movers on our radar this morning. This is a fun one. United Airlines making its biggest ever international network expansion in 2027, adding destinations in Europe, Asia, using newest jets from Airbuses. New locations include Ibiza, Luxembourg, and Marseille. Isabel, we go to Valencia after the show?
Why not? Actually, when we talked about that in our chat, I was like, it all sounds like tourist destinations I would love to go to, but we would need more vacations.
I wonder if people go to Luxembourg for a tour. I feel like that's for because you have a fund out there because you don't want to pay taxes.
I was going to say you wash something there, but I mean, why not? I would love you wash clothes there.
Clothes, sure. By the way, just want to point out we will have more of that interview with Lisa and the CEO of United, Scott Kirby, in the next hour.
And let's also get to the digital asset world. Crypto stocks are rallying. Actually, no, it's kind of mixed there. Coinbase higher, or I guess Coinbase is flat. Oh, now it's red on your screen. Coinbase Strategy Circle, all in the red, and that's after Bitcoin touched $80,000 for the first time since May. Chatter around the debasement trade is helping drive inflows as U.S. Treasury steps up bond purchases.
Some more earnings for you after the bell this morning. That will be Zoom and Intuit. It's a test for the software space that has been heavily scrutinized by the rise of AI. So Zoom, Intuit, Salesforce, all those down ahead of the bell. We're also going to get CrowdStrike earnings and Salesforce later this week. But first, coming up, we're going to talk about real-world earnings. Dick's Sporting Goods lowers its full-year guidance after Foot Locker results fall behind. We look at the retailer coming up next. This is Open Interest.
Now to high interest, a look at what's making headlines around the world. Volkswagen CEO Oliver Blume telling workers that roughly half of the car maker's additional job cuts will need to happen in Germany. The cuts aim to lower costs and compete with electric vehicles, software shifts, and Chinese rivals. Blume's comments coming as labor leaders warn of possible strikes over the restructuring plans. And Apple is gearing up for the launch of its first new Mac Mini in 2 years. Sources telling Bloomberg that the new desktop will debut as soon as the coming days. It's part of a wave of fresh products coming in the second half of this year, including new Apple Watches, AirPods, and a smart home device. And Dick's Sporting Goods lowering its full-year outlook due to the weakness at Foot Locker, overshadowing sales gains from World Cup. The chairman pointing to U.S. consumers who have become more choosy amid rising costs. The retailer bought Foot Locker last year for $2.4 billion. Dani?
Isabel, let's get more on that story. We are joined by Lindsay Dutch. She is a senior retail analyst at Bloomberg Intelligence. Isabel was just laying it out there, Lindsay. Does this mean that we should look, with the benefit of hindsight in this earnings report in hand, the buying of Foot Locker as a mistake for Dick's Sporting Goods?
Hi, Dani and Isabel. Thanks so much for having me. And I think that your point about it potentially being a mistake is what investors are worried about and the reason for the market reaction today. This quarter was the quarter for Dick's to prove that it had what it took, the brand relationships, to make the assortment better, to turn around the Foot Locker business. The goal was to do that by back to school season. We should have seen evidence that the turnaround was coming to fruition, and it had been going better than expected about 3 months ago, but the results today say that there's significant challenges in making that turnaround happen.
What does the Foot Locker weakness tell you, Lindsay, about the consumer? Are they finally saying no to maybe $150 sneakers?
Yes, that price point is definitely $150 now. And I think you're right in that we have to delineate between the two businesses. So the big risk for Dick's going after Foot Locker is really lifestyle footwear. It's not really driven by sports-focused demand. You know, it's not people going out there running. Running shoes are trendy, but you're still relying on discretionary demand and people just wanting to wear those shoes because they're trendy. And I think this quarter we saw that the Dick's management was not fully prepared for a rapid swing in that demand and a rapid pullback in this second quarter from consumers.
Lindsay, when I think about, well, to be honest, both Dick's Sporting Goods and Foot Locker, where I tend to see the most is in malls. I know that's the case with Foot Locker. Dick's Sporting Goods has a big presence there, too. Is that footprint an issue that they also need to be addressing, Lindsay? Just their reliance on mall shoppers coming in and visiting their stores and purchasing items?
Yeah, it's an interesting point, and I do think part of the Foot Locker acquisition was for real estate. There's really no new retail shopping centers being built anymore, so if you're a retailer looking to expand, you have to find space in existing centers. And for Dick's, buying Foot Locker, it added over 2,000 stores, and it really expanded their reach to different consumers. And I think that was a real piece of their interest in the business. Dick's is both off-mall and on-mall. With their House of Sport location, which requires huge boxes, they're actually leaning more into malls. And they're taking some of those empty Lord & Taylor boxes, empty Sears, because they need that huge space for that House of Sport concept that they're building. I don't necessarily think where the store is, whether it's off or on mall, matters, but the off-mall traffic has been building since COVID. It is very steady, and a lot of retailers like that off-mall presence just because you have a grocery store or a weekly needs-based retailer that consumers are going there anyway.
Lindsay, thank you for that insight. Lindsay Dutch of Bloomberg Intelligence. Maybe, Dani, we do need to wear cheaper sneakers from here on out. I have upgraded my sneaker starting this year.
The problem is that I've tried to take my health more seriously, so I'm actually doing things like working out and running and playing tennis.
No, it's really health.
Yes, no, it's health, and you need shoes that are sturdy and can sustain that. So you can't necessarily buy the cheaper shoes out there, or else they'll disintegrate on your feet.
That's true. My mom has plantar fasciitis, which I don't know why I'm talking about that, but yes, she does invest in
I don't know
good
if she's
sneakers.
Foot Locker's target audience, but point taken, Isabella.
Thank you. Coming up, we have Crossmark's Bob Dahl, who says the Treasury's attempt to sway yields are destined to fail. He joins us next. This is Bloomberg Open Interest.
Crossmark CEO and CIO Bob Dahl says, quote, attempts to limit or even reverse the rise in U.S. Treasury yields will ultimately fail. Dahl argues that the upward pressure on interest rates and bond yields will only reverse once global economic activity weakens and or inflation pressures recede, neither of which are likely in the near term. So pleased to say that Bob joins us now. Bob, I would take it that Stan Druckenmiller agrees with you, considering his piece in the Wall Street Journal this morning. It has been widely criticized, the move that this Treasury has made, what Bessent has done, someone who had been a mentee to Druckenmiller as well. So what do you make of the steps themselves. Why even pursue this line of tact, given that it is a market that is pushing back both via where bond yields making near a round trip and commentators saying that it was a mistake?
And Scott Bessent is extremely intelligent, so be careful how much I criticize. But I think what has happened is a player, the U.S. government, a big player, is trying to say we don't like interest rates rising. Let's see if we can slow it down and or stop it and or reverse it. And my view is the market's going to go where it's going to go. And if inflation remains problematic, it's going to be difficult to get interest rates down.
What about Treasury yields? So to Dani's point, they've been pushing higher even as the economy remains fairly resilient. Do you think that they're now the threat to the bull market?
Eventually they are. What level is really hard to say. I mean, if you had told me that the 10-year and the 30-year would be where they are today at the first of the year, I would have thought the equity market might have had some more trouble. But so far, tolerant. Part of it's the pace at which rates have moved up. It's been slow. And I think the equity market has said, yeah, but my earnings are phenomenal. Therefore, I'm not going to worry about interest rates. We'll see how long that lasts.
One could even make the argument that the reason that yields are moving higher is because this economy looks strong. The Citi Economic Surprise Index is its high since 2022. So, Bob, what happens in a world where it seems like this administration perhaps has inadvertently sent the message that they are worried about 30-year yields, a yield that even Kevin Warsh says that he's not concerned about? Is there some signal to be gleaned from that it does seem like it's an administration that's so concerned about long-dated yields?
Yeah, they have to be with, I'll repeat, inflation where it is. Oil prices, I mean, they're down today, but they're higher than they were at the start of the year. And then, of course, the debt and the deficits crossing that $40 trillion mark, $1 trillion on interest. That is problematic and is part of the reason the bond vigilantes are out there saying enough is enough, and interest rates have been creeping higher.
Bob, you're going to stick around with us. We have the opening bell to get through. That's Bob Dole of Crossmark as your equity futures rally just moments away from the opening bell. We'll have that on the other side of this break. Let's get your trading day started. This is Bloomberg Open Interest. I'm Dani Burger alongside Isabel Lee. Matt Miller is still out, and it's an equity market that is rebounding this morning as yields come in, as the price of oil drops, as some of the AI scaries abate, at least for today. We have Nvidia to get through tomorrow. So the NASDAQ outperforming. Down at the New York Stock Exchange, very cool. We have the government of Puerto Rico and the governor ringing the opening bell. I'm not quite sure why, but Bad Bunny did just finish his historic tour with 2 nights in Puerto Rico. So I'm going to just say that they're there to celebrate that because that's pretty cool. Anyway, NASDAQ. Down there, you have Vanderbilt University, the chancellor ringing the opening bell. They have opened a new campus in New York City, so they are celebrating that. I'm assuming some of the people wearing the T-shirts are students of Vanderbilt. How cool to get to go and ring the opening bell down at the NASDAQ. Certainly never had the opportunity to do that. Isabel, what you looking at this morning?
I did not see the Bad Bunny reasoning coming. I have a lot of friends who were so happy watching the concert. I didn't watch. I'm not a concert goer.
Yeah.
Did you
I
watch?
mean, I would have. I didn't go, but I definitely would have wanted to. He's excellent. Yeah.
No, I'd rather save my money for a $150 pair of sneakers.
Okay.
On our deck this morning, our tech stocks. Of course, tech sentiment is starting to rebound this morning with chip stocks leading the recovery after a sell-off yesterday. You see green on the screen, Nvidia higher by 1%. Of course, Nvidia reports tomorrow, and you're really probably going to see investors buying the dip ahead of the earnings. Micron higher by more than 2%, and SanDisk up by also 2%. Again, Nvidia tomorrow, and maybe it could be the test, Dani, on whether AI trade has more to go.
Another set of earnings we were watching this morning. Dick's Sporting Goods down by the most in 3 years, dropping 20%. It's been struggling to maintain its sales growth from the World Cup. The company also lowered its full-year outlook due to weakness at Foot Locker, the sneaker chain it bought last year for $2.4 billion. So we're almost through the bulk of earnings season, just Nvidia to really play for. Let's bring back in Crossmark CEO and CIO Bob Dole. Bob, in just over 24 hours, we'll get Nvidia. And then to round out the week, we'll have Jackson Hole with Chair Kevin Warsh. What to you is a bigger risk event for this market?
Probably the Kevin Warsh comments or lack thereof. Not that Nvidia is unimportant. It's obviously a bellwether. The stock is pretty cheap relative to earnings, according to most people. I would agree with that. So let's hope they can come in with acceptable earnings and buoy the whole group for a while.
If Kevin Warsh is the more important event, as Dani pointed out, and as you pointed out, What are you looking to hear from him? Will we even hear anything from him? Sometimes they're starting to think whether his lack of communication is a liability or an advantage.
Yeah, great question. I think the uncertainty and the unknown still has investors a little bit spooked. The question is, will he tip the hat to the more bullish, hawkish folks on the Fed that are concerned about inflation, or will he just stifle and not say much at all? I think the latter. Markets won't particularly appreciate that.
And this maybe brings us back around to where we started, Bob. Just how much has his life been complicated by what the Treasury is embarking on?
Yeah, great question. Certainly, that's an issue that he's got to deal with. Look, I think he's trying to buy some time till the 5 committees he set up can come back and report here in the next few months, and then maybe he'll chart a course that we can understand and get behind.
What about earnings? To Dani's point, we're almost at the end of it. I think around 87% of the S&P 500 companies have reported. Earnings are strong, but why do you think stocks aren't rewarding the beat so much?
That's a great question. First of all, the amount of the beat remains strong. But I note that the 2027 estimates, next calendar year, as of July 1st, the estimates were up 17%. Only up 13% now. That's still a good number, but you don't like the direction. I think the market's starting to say, how much stronger can earnings get? And then back to what we've been talking about, if interest rates are going to continue to creep higher, can I sustain a multiple of 20 or higher?
To that point, Bob, do we need to start paying attention to the cost of capital for all of these tech giants who have started to spend more? Whether it be the direction that treasuries are moving in, be it Broadcom seeing their CDS spreads blow out. Does this represent a challenge for them as they embark on this path of not just spending, but of borrowing?
Yeah, great question. And I think the answer is yes. We do need to keep our eye on it. Look, a year or so ago, they were financing all this out of cash. And then it was bonds, and then it was stocks, and then it was, we call it circular financing, and then it was, trust me, I'll find the money. So, yeah, I think we have to watch carefully at how much these companies are borrowing to support, in some cases, sales from other people of their own products.
Going back to where we started, you argue that attempts to cap treasury yields could ultimately weaken the dollar. What would be the catalyst, in your view, that would bring bond vigilantes back?
So my view is they're already they're warming up, if not already singing a song. There's no question that with the level of debt and the level of accumulation of additional debt, the level of interest rates, the bond vigilantes have to be waking up and not be happy.
To what degree are there even vigilantes, though, at this moment, Bob, considering all the fundamental pillars to why yields are moving higher? Is this not just a market that perhaps instead of vigilantes, it's just underscored by more price-sensitive investors when central banks and even the Fed have pulled back in their involvement in this treasury market?
Now, I don't disagree with you at all. I think there is a key part of what's going on in the market that's looking at those very things. Decent economy, inflation that's not down to the Fed's level or looking like it's going to get there anytime soon. Oil prices stuck at much higher levels than where we started the year. And then this incredible cost to maintain our debt. That's all got to lean on fundamental fixed income investors and say, how much of this paper do I want at these interest rates?
Let's go to inflation. Inflation has cooled, but you point to liquidity, bank lending, and government spending as reasons it could remain sticky. What, in your view, is the market missing?
I think the market is right on about inflation. Look, the market wants to believe, let me say the stock market wants to believe that the Fed's going to get inflation back to 2%. I think if the market really believed inflation was going to be 3 instead of 2, we probably lose a couple of PE points on the market. So the stock market is giving the Fed and the environment the benefit of the doubt that inflation is going to get down to 2.5, 2.25, 2%.
We have had recent inflation readings that have looked benign, Bob, and you also had retail sales, which looked not as strong as they have been in the past. We'll get a read of the consumer in just under 30 minutes' time. Is the direction of travel not a comforting one, or is this still an inflationary environment that needs to get the attention of both markets and the Fed at this point?
Look, I think the Fed, probably some of them wish they had never said 2% as our target. They can't back down on that. But you're correct. You're pointing out the consumer's not as strong as it was. I'm not going to say weak, but maybe weakening a bit. Consumer confidence points to that. But the capital side of the economy, CapEx, as well as the manufacturing side, still seems pretty robust. And that, of course, is a big user of capital and reason all the demand for funds.
Bob, good luck to you for the rest of the week. I think we're all going to need it. We really appreciate you joining us. That is Crossmark's Bob Dahl. Let's get a check on your equity market now. We're just about 8 minutes into your trading day, and we are up about 0.4%. The breath ain't great. About 300 stocks are down. So majority of stocks are down. But the reason that this overall index can do well is because we're seeing a bounce back in the AI sectors. Again, they were harmed a lot yesterday. I mean, assign whatever narrative you want. Nvidia raising prices. Sam Altman saying things weren't being as adopted as quickly as he had hoped for. But it's rebounding today. We'll see whether Nvidia's earnings can cement that tomorrow. On the downside, no surprise to see energy performing poorly. You do see some consumer staples and discretionary names not doing well. Does Dick's Sporting Goods hurt things? That's part of the reason that Nike is down so much. But just a reminder, it is the summer months. You can get these outside swings. Dick's Sporting Goods, again, I think down like 20% in the day's trade. So just looking at some of the sectors, again, energy, the worst one, followed by consumer staples. You saw Walmart wasn't having a good day. Infotech, industrials, those are having a good day. And that's enough, Isabel, to get us to a gain so far this morning, just about 10 minutes into your trade.
That's right, Dani. It's summer and things can swing back and forth. But then to your point, the retailers they had good earnings, and it shows that consumer spending is still remaining healthy. But we shall see more to come on that. Coming up, we're seeing a turnaround in sentiment with chip stocks. But Nvidia's earnings tomorrow face a high bar. We discuss with Mandeep Singh next. This is Bloomberg Open Interest. Time now for a top call. Some of the analyst action and focus this morning. First up, Wolf Research upgrading Moderna to peer perform. Wolf pointing to the company's successful melanoma vaccine trial results. Last week, you see the shares there pop by more than 8%. Next up, Loop Capital downgrading 5 below to hold. Loop Capital saying it's looking for a more attractive entry point with its bullish view already priced in. And you see the stock there down by nearly 2.5%. And finally, Raymond James upgrading AMD to a strong buy from Outperform, saying the company offers, quote, the strongest combination of direct earnings leverage, given the data center positioning and market share gains. You see the stock here pop by 3.5%. Dani.
More broadly, we are looking at chip stocks moving higher ahead of Nvidia earnings tomorrow. They were down sharply yesterday. Many of the AI stocks were. Sentiment started to turn, whether it was because of Nvidia hiking prices, be it some negative commentary-ish from Sam Altman saying that things weren't speeding ahead as quickly as he thought they were, and others. But tech does appear to be improving ahead of Nvidia earnings. Let's bring in Bloomberg Intelligence head of global tech coverage, Mandeep Singh. So we just logged 7 straight days of losses for Nvidia, the longest running streak since 2022. How tall is the order of Nvidia to prove that this AI boom is racing forward?
Well, I mean, like every quarter, they have to beat and raise. But more important here is what kind of upside they get from someone like SpaceX announcing a target of $100 billion in ARR by the end of the year and really pulling forward some of their targets that they shared during the IPO. So SpaceX has said going forward, they will be only using NVIDIA chips. And they are being very aggressive about ramping up live capacity. And SpaceX has shown a proof point that they can rent out that NVIDIA compute for probably the most premium pricing that is out there. So from that perspective, if SpaceX is the big customer, new customer among the hyperscalers, then what does it do to NVIDIA's estimates for the back half of the year and 2027? I think that, for me, is the key in this print.
Is NVIDIA's biggest constraint still supply, or is demand finally changing?
Well, the demand-supply mismatch remains. Everyone wants more compute. So I think what investors care about is, do the Blackwell chips make a difference in terms of the quality of the models that are being trained. Because remember, Anthropic has the best models, but so far they were using TPUs. They weren't even using Nvidia chips. So from that perspective, now that Anthropic is a customer of Nvidia, does that make a difference in terms of the throughput that Anthropic is getting and what it does to their model quality? All these things will play a part in terms of how investors will look at the earnings print tonight.
Mandeep, does that mean that when Anthropic becomes a public company, the correlation between their performance and Nvidia just becomes really intertwined, that you need to see Anthropic making announcements of improvements in their model in order for Nvidia to continue to rally?
Well, so Nvidia serves OpenAI and all the frontier models. But at the same time, you're right. I think if Anthropic attributes some of their model quality improvements to the chip provider, whether it's TPUs or Nvidia, then yes, it will move the stock. At the same time, what Nvidia wants is a much bigger ecosystem. They want open weight models to do well. They've, in fact, trained their own open weight model, Nemotron, and giving it for free to others. So from that perspective, they want a bigger ecosystem as opposed to a concentrated two-model provider ecosystem.
If we take a step back, are sovereign AI and financing channels becoming a bigger driver than hyperscalers?
Well, so last quarter, they started giving additional disclosure around how much is their hyperscale revenue, which is around 50%, and how much is sovereign and enterprise revenue. And so from that perspective, they do expect sovereigns to be a much bigger portion going forward. But at the same time, I think the near term will be driven by SpaceX, which to my mind is a hyperscaler, given the kind of targets that they have given around their compute ambitions.
We're also going to get a whole host of software earnings coming out, too. I've been thinking a lot about the pace of adoption recently. I've mentioned ad nauseum that interview of Sam Altman saying things aren't being adopted as quickly. Even the post from Stan Druckenmiller today of everyone saying it's AI and like kind of pushing back against the idea that he would use it. Almost, Mandeep, seems to be that we're not in this place that we're like widely accepting some of the uses of AI. And I wonder if that's the place that software finds itself in yet. That a lot of noise has been made about legacy systems being replaced by AI, but we're far from that reality.
Yeah, and the market of late has been more discerning among the ones that have been disrupted in terms of growth slowing down versus the ones that have actually seen an acceleration in top line growth. So from that perspective, I don't think we are at that SaaS apocalypse stage we were in earlier in the year. And now it's more about, okay, prove me wrong. If you are showing me sequential acceleration in top line revenue as a SaaS provider, you will get re-rated. And I think we are starting to see that.
In general, are these software companies becoming more attractive for private equity companies? That's really zooming out a bit, but just curious.
Well, we saw that Workday deal. So from that perspective, it was pretty big in terms of, what kind of interest private equity may have. But I think right now we are at a point where you have to figure out which segments of the market are exposed to LLM disruption. And coding agent is a notable example of that. And then you figure out which are more insulated and, where they can incorporate their own AI and get a lift. And that's what I think private equity and everyone in the investing world is trying to figure out. Like, these are the pockets where AI will be more of a tailwind and they're not at the risk of disruption.
So just thinking about that, because it does feel like a lot of PE firms have kind of pivoted away from just like plain enterprise SaaS and are going more into services, or you're like a Vista and going more into chips with Samba Nova. Is that kind of the direction of travel, that services seems like the safer, cushier area to hide out in if you're concerned about AI and software?
Yeah, I think, look, the vertical software names have always had their place in terms of, having some sort of a unique moat. And from that perspective, this feels like more horizontal, like coding agents. It impacts every sector. But vertical is where you need unique data to create your own intelligence. And that's where I think the market will be more discerning. The chip side, I think, is so elevated that it's hard to see any private equity action over there, given how the multiples have gone up.
Mandeep, so great to have you. I'm sure we'll catch up tomorrow ahead of those Nvidia earnings. Mandeep Singh from Bloomberg Intelligence. Coming up on the show, the SEC is looking into trading at hedge fund situational awareness and the bank exposure to it. That's coming up next. This is Open Interest. 20 minutes into your trading day, and we push higher. That outperformance being led by tech this morning after a rebound of AI-related stocks from yesterday's sell-off. 10-year yields, that is a crucial pillar helping this market, down 3.5 basis points. Brent crude falls under $90 a barrel as the U.S. pursues economic warfare, in the words of this administration, versus kinetic warfare. New York Times report says that we are bringing diplomats back to the Middle East. That helps Brent crude take the pressure off of it. Elsewhere in some of the individual stocks, Nvidia, off the back of 7 consecutive days of losses, its longest losing streak since 2022, finds firmer ground this morning, up 3%. Dick's Sporting Goods, that is on track for one of its worst days in a few years after it sells off following an earnings. That's also dragging down Nike with it as Foot Locker underperforms. Micron and SanDisk, I mentioned those. AI stocks rebounding this morning. Speaking of AI stocks, situational awareness, those were some of the big bets that it had made, specifically SanDisk, before last month's sell-off. Now a new turn in the story. The SEC is looking into the fund's trading activity and has sent subpoenas to major Wall Street banks looking into prime brokerages. Here to discuss with us is Bloomberg hedge fund reporter Hema Parmar. Hema, I would just kind of assume like this is what you would want to see and hope to see from regulators after such a monumentous sell-off?
Yes, I mean, the SEC prides itself on really protecting the smaller investors. And if you look at Situational, it had a lot more regular people or founders or individuals investing in it than, say, bigger institutions. So this probe, and we will say that it is in its early stages and it may not result in any actual enforcement, but it does show that the SEC is examining what was something of a pretty huge hedge fund blow-up. The firm still exists, it still has multi-billion dollars, but that decline from 45 billion in assets down to about 10 is something that's kind of wild in our space for sure.
It definitely is wild, and you've published scoop after scoop on this. I mean, we've seen trades blow up. So how big of a deal is this, and how much of an anomaly is this in the industry, or is it just, one of those that are because it became a headline name that people always look at because of the founder and all of that, and the backers?
So it was something of a pretty sizable anomaly in the space. A hedge fund shouldn't lose the kind of performance it has lost, and it shouldn't also have these kind of gains, thousands or hundreds of percent gains. Both of those things are not typically what you would like to see from a hedge fund in its performance, but we have seen some outliers as well too. Archegos, the SEC looked into Archegos, the SEC looked into Melvin Capital when that fund basically blew up. Not all of them, they took action with Archegos, they didn't with Melvin. And to be clear, both of those firms were a lot more dire situations than situational awareness, because the firm continues to exist and does still have investors.
Well, isn't one of the unique parts of this, Hema, that with those other examples, it did feel like they were kind of in their own universe. There wasn't a lot of correlation. It feels like you and the team have been reporting that situational awareness's downfall, I mean, not ruin, but their downfall has affected so much more of the hedge fund community than perhaps some of those past examples did.
It's an example of leverage, which is the biggest offender when it comes to these sorts of things, because the trades that Situational did were not groundbreaking. They were long a lot of tech companies you would bet on for the AI trend. They were short software. They were in names a lot of other hedge funds were in. But they took on 4 to 5 times leverage and really added that risk. So that is not what investors like to see when it comes to these sorts of actions at a fund.
I mean, Dani, you covered ETF in your past life. They're trying
Feels like a very long time ago, but yes.
Some issuers are trying to go for 4x and 5x, and I mean,
like
so
your 3 times inverse SpaceX fund. You see it in Korea, leverage being really pervasive throughout the entirety of the investment landscape. Hema, excellent reporting as always. Thank you so much for joining us. That is Hema Parmar from our hedge fund team. Coming up in hour 2 of Open Interest, Marija Veitmane of State Street talks about tech earnings, sustainability. We get the big one tomorrow. In just over 24 hours, we'll hear from Nvidia. Plus, we're also going to hear from United Airlines CEO Scott Kirby sitting down with Lisa Abramowitz just about an hour ago, talking about expanding its flight offerings. That stock is higher this morning as the overall market rallies, led by a rally in Treasuries. All that's coming up in your hour 2. This is Open Interest. We are 30 minutes into your trading day. Welcome to Bloomberg Open Interest. I'm Dani Burger alongside Isabel Lee. Matt Miller is still out, and it is a market in rally mode. Can it sustain itself? Coming up on the show, Nvidia tries to snap its losing streak ahead of earnings while software stocks face a gut check.
And Scott Bessent faces pushback from his former mentor. Stan Druckenmiller calls Treasury bonds buying a mistake.
Meanwhile, Bessent's Iran strategy risks putting Washington on a collision course with Beijing. We start with economic data, though, crossing the terminal just now. We're getting consumer confidence, new home sales also coming in. Consumer confidence for August weaker than expected. Let's bring in Michael McKee, Bloomberg's international economics and policy correspondent. Mike, what are you looking at?
Well, what we're looking at are people discouraged about what's going to be happening in this country. It's largely in the expectations index. Headline comes in at 89.4, down from a revised 90.2. And then the present situation rises to 121.2 from 114.9. Now, the expectations index is a big drop, 68.2 from 74.4. And so it looks like people are not happy about the direction of the country at the moment. We have a couple of other eco data points coming out now. New home sales come in weaker than expected. 607,000 annual rate, down from 678,000 last month. It's a 10.5% drop. Also, the Richmond Fed Manufacturing Index comes in at 4. That's down from 5. It was expected to rise to 7. And then the Business Conditions Index is negative 12 from negative 5. So there certainly is a lot of unhappiness out there, both it looks like on CEO's point of view from the Richmond area and the Conference Board Consumer Confidence. The fall in, obviously, the new home sales is no surprise given what we've seen with mortgage rates recently.
Mike, talk to us about the significance of Stanley Druckenmiller's Wall Street Journal piece criticizing Scott Bessent. Dani made a point earlier that the two obviously have a mentor-mentee relationship, and it's not lost on us that Druckenmiller also recently employed Kevin Warsh. How is all of that related? And maybe are they speaking to each other?
They spoke all the time. Kevin Warsh was working for Stan Druckenmiller when he was appointed. It's not clear whether they spoke in the last 24 or 48 hours, but obviously Druckenmiller wanting to send a message, a strong message to his mentee, to his former employee, that you can't fight the bond market. The bond market is collective wisdom, and the Treasury Secretary was substituting his own judgment for that, which would not work out. So Druckenmiller's kind of puts an exclamation point on what a lot of other people have been saying, which is this is manipulation. It's not an effort to really help overall the liquidity or operations of the market. So definitely a strong condemnation from him, but he's not the only one. Ken Griffin, the Citadel Group, with the same message yesterday, and we've seen the same from pretty much every bond house on Wall Street. One quick note here in terms of the consumer confidence. Jobs plentiful rises, jobs not so plentiful falls. So people think that right now the labor market isn't all that bad, but coming up in the future, a drop in the more jobs outlook for employment and an increase in the fewer jobs numbers, also a drop in expected incomes. So people are not happy. The underlying data for the consumer confidence numbers is not particularly good.
Mike, thank you so much for your coverage. I mean, this Jackson Hole just got a lot more interesting. Bloomberg's Michael McKee, and you can watch him in the Bloomberg Surveillance Jackson Hole special. Coverage kicks off on Thursday, but that special happens on Friday. The team will be drumbeating to Fed Chair Kevin Warsh's keynote address. That coverage begins at 9 a.m. New York time. Joining us now is Marija Veitmane, State Street Global Markets Head of Equity Research. Marija, this is something that you've been laying out, that it is a world in which the Treasury market has started to look a bit more concerning, be it the Treasury's actions, be it just straight up elevated bond yields. Yet the market, the equity market, has not been reacting to that. It's been reacting to stronger earnings. Is there complacency given the dynamic?
Well, I mean, yes and no. So within equity, so overall, we see kind of strong demand for equities and kind of institutional investors still putting money, taking money out of bond market and putting into equities. But when you look under the hood, what they're buying, there are only like a couple of areas where we see strong investor demand for stocks. Is tech. That, to be honest, it's the only sector where investors are buying. Everything else is being sold off. And regionally, it's US, it's emerging markets, kind of Asian emerging markets. That's what investors are buying. So they're going for areas where there is some certainty about kind of underlying earnings growth. So in a world where kind of bond yields are rising, when we really uncertain about kind of the safest assets, where is the safe haven? Safe haven is good earnings. And that's exactly what investors are doing.
Okay, so maybe that sets us up for, well, many on the street are hoping is a good earnings for Nvidia tomorrow, Marija. How are you thinking about the results, especially off the back of continued shakiness in the AI sector and for Nvidia itself, 7 straight consecutive days of declines?
Yeah, I mean, again, kind of going back to what kind of revealed preference, what investors are doing. They're buying tech, they're buying kind of everything across the board within the sector. Like earlier, like in this, like a couple of months ago, we saw kind of rotation from semis into software, and kind of software appetite for software really dominates, where kind of holdings been very low, the people sold out of the sector, they're beginning to come back. Now it's kind of broadening, so it's software, it's hardware, and it's semiconductors, and nothing else. So I think that's kind of the crucial point, is that what is the alternative to tech? And investors are coming short. And particularly interesting, they're really selling bond proxies. So utilities, the sector you'd normally buy in a world where kind of bonds are selling off, that's the sector with the biggest outflow. So they're not really going into kind of traditional bond proxies. They're going for quality of earnings.
You also argue, Marija, that higher rates don't necessarily derail equities for now. What is the level of yield that will finally make you change your mind?
I think that's a really good question, but I think we probably need to dip a little bit deeper. Is like why yields are going up? Is it inflation risk? Is it growth risk? Is it risk premia? And right now is kind of risk premia. And what investors are telling us is that they don't want specific U.S. kind of fiscal risks, and they're selling out of there. As I said, they're buying tech, they're buying emerging markets, they're buying emerging market currencies. So it's really kind of understanding the reason for that. And right now, strong earnings in kind of tech space provide you safe haven there. So that is there. But don't be kind of fooled. It's not all equities. And I mean, it's interesting. We just had consumer numbers, consumer sentiment. That's where we actually see quite a lot of weakness. And like looking at margins for consumer stocks, I mean, we had a big food retailers kind of reporting last week, big misses. So it's not everywhere in equities that we feel safe, but it's where earnings are stronger. And I mean, you know myself, I'll tell you that all roads lead to tech, but not everywhere.
I mean, it's so true. And look, you see it in the earnings, right? So you have something like 30% earnings growth this quarter. Very solid majority come from tech and come from energy. I was just looking at our Bloomberg intelligence numbers. Healthcare is starting to trend weaker growth year over year for this quarter. Consumer discretionary is only something like 4%. So when you look at the S&P 500, is it a story at which these are not spectacular earnings? Instead, it is spectacular earnings from just a few.
Yeah, absolutely. And that's been the story for last 2-3 years, when we talked about tech being strong and carrying everyone. And I think it's very natural for investors to try to look for opportunities to broaden, because I mean, we know everybody holds a lot of tech, and I mean, the risk is kind of, okay, do I sell it or not? But people are really tempted and to look for like cheap kind of look into value stocks, into small caps, and exactly as you say, Dani, it needs to have good earnings, particularly in uncertain times right now when term premiums are rising. And that's potentially why we're seeing people kind of flooding back into tech stocks.
So maybe to wrap this all up, Marija, what is the one thing that would actually surprise the markets right now? Is there a consensus trade that you don't agree with, that you think the markets are underpricing?
I mean, people are very keen to buy small caps. People are very keen to buy. I mean, so let's kind of maybe chat about small caps. So it is kind of, okay, we look like overall U.S. economy is doing well, and potentially kind of overall level of earnings is doing okay. And actually you're showing Russell 2000 on the screen is kind of performing. And I think that's a trade people really want to do. I think for us, that's a big risk because those stocks, particularly small caps, are really interest rate sensitive. They will really struggle. Well, I mean, they're already struggling with high interest costs and they really need low rates. That's not forthcoming. And kind of, say in US, more than a quarter of those small cap companies are loss making. So they really need lower interest rates and kind of dynamism in economy. And that's not what we have. We have a pocket of economies that are doing really well and pocket of earnings that are doing really well, but it's not really broad. So I think small caps is particularly a trade for me to kind of look to fade.
Marija, great to have you on. Thank you for joining us. Marija Veitmane of State Street. Let's get a check on your markets about 40 minutes into your trading day, and the broadest of gains from tech and from the NASDAQ start to calm down. And we did just get those consumer confidence figures that were weaker than expected as 10-year yields moved down by 4 basis points, also helped by Brent crude down 3%. As well, let's look at some of the single stocks that are moving this hour. Tech sentiment is rebounding. Chip stocks, memory stocks, optic stocks, all of them sold off hard yesterday. Nvidia's are buying the dip ahead of tomorrow's risk event, that being Nvidia earnings.
And we have the exporting goods, which reported earnings this morning. They're struggling to maintain sales growth after the World Cup. You see the stock there down by 25%, double digits there. Its full-year outlook was also lowered by the company due to weakness at Foot Locker, Dani.
And United Airlines adding 10 destinations in Europe and Asia in its network next year using the newest jets from Airbus. And we are going to bring you Bloomberg's interview with CEO Scott Kirby later this hour.
Coming up, we have Thoma Bravo facing a $9 billion debt wall as lenders gain the upper hand. We'll have more next. This is Bloomberg Open Interest. Now time for high interest, a look at what's making headlines around the world. The Trump administration is proposing a new H-1B visa fee after a federal court struck down the previous fee of $100,000 back in June. Under this new plan, companies would pay roughly $103,000 for each candidate they sponsor. So unlike the earlier initiative, it would apply to almost anyone getting a new visa, not just those who are outside of the country. And the SEC has sent subpoenas to major Wall Street banks regarding the hedge fund situational awareness. Sources telling Bloomberg they're seeking information related to the trading activity of the hedge fund. Situational awareness came under pressure last month and was forced to exit many of its positions. And Thoma Bravo made huge concessions to some of Wall Street's biggest money managers, which include BlackRock and Invesco, for debt it needs to repay for its acquisition of cybersecurity firm Proofpoint. The talks resulted in 40 creditor-friendly changes to the deal documents. The Proofpoint negotiations offer an early glimpse of the concessions Thoma may need to make as more loans come due. Dani?
Isabel, let's talk more about this. For more, we are joined by Bloomberg Chief Wall Street correspondent Sri Natarajan. Sri, I was just thinking earlier this year, around April time, I'd interviewed Orlando Bravo when Medallia was kind of facing its issues, and I'd asked him about the cost of capital, and he basically was like, yeah, some lenders are pushing back, but we have a lot of lenders, we have really good relationships, it's nothing we can't handle. How extreme is the pushback and the concessions that they are needing to make in order to continue to get debt to fund these software companies?
You're talking about earlier this year. Let's take you further back. Go back 5 years and the tables were completely turned, right? The borrower could put a gun to your head and demand whatever terms they wanted because it was such a borrower-friendly time when you go back to 2021. Now, completely different scenario. And when you think of a firm like Thoma Bravo, especially one that's such a specialist in the software space, that was their niche. That is where they built their strength. That is where they built their dominance. But right now, in a world where there's so much nervousness around any AI vulnerable sector, and the SaaS companies and anything in the software space is high up there, lenders certainly have the upper hand, and they are willing to exact the terms that they want to make sure they continue to lend. And that's what we're seeing in this situation, whether it's higher interest rates to refinance the debt, limits on future borrowing, regular check-ins, prayers every single second of the day. I mean, they have asked for 40 different terms, so I have to assume there must be some crazy terms in there. But the point is that the number is a real signifier here of who has the control, who has the leverage, no pun intended, and it's all with the lenders right now, especially if you're a lender in the software sector.
Why don't we take a step back, Sri, because there's so many stories relating to private credit right now. So do you think, in general, this creates an opportunity for large private credit platforms to just acquire seasoned portfolios? Is it a good environment for them?
If we're talking specifically in the software space, it's an interesting period, right? And again, going back to what Dani talked about, her interviews with Orlando Bravo, you go back earlier in the year and he was ready to go out there on TV and declare the SaaS apocalypse is over. That might be true. We're not near the fear cycle of what was happening a few months back. And if that was the case, these lenders could have exacted 400 lender-friendly terms, perhaps. But we're still in a place where they will have to give a little bit to the lenders. The private credit borrowers or your syndicated lenders, they will be able to demand terms, and the companies really have no option, especially for a firm like Thoma Bravo, which is you deal with one situation, you know that over the next 12 months, you have so much other debt that's coming due because you have such a robust portfolio in a vulnerable sector that you have to have a lender-friendly posture. You can't afford to walk away from these negotiations because you will be hurt down the road.
And again, you know, Orlando telling me in a conversation, like back when money was free, that was the anomaly. This period that we're in is not the anomaly. But that being said, one of the impacts of rising rates, or at least rates which haven't come down, has been a lot of aging assets on private equity balance sheets because they bought them for so much at such high valuations in 20 and 21, and you haven't had the benefit of lower rates to kind of bail them out. The team has been doing great reporting today's big take on just sort of the liquidity mechanisms that they're tapping, be it continuation funds, structured equity, dividend recaps. Sri, how many of these are unusual or alarming versus just kind of a normal course of business of trying to inject more liquidity into portfolios?
Unusual in that we're finding new and new structures come into the private equity deal spectrum. Again, when you're talking about $3.8 trillion in unsold assets, aging assets and itchy investors, you have to find ways to return capital to investors. But I'd also like to point out that there is a bit of a dilemma for all the private equity owners, right? On the one hand, your investors, your LPs will tell you the number one most important metric to them is distributions that come back to them relative to paid-in capital. And then, if you frame the question differently, what do you prioritize between long-term returns and near-term liquidity? That all say do not sacrifice long-term returns. So which way do we go? You really have no option. The answer is keep returning money to me, keep making sure you have great returns, and that puts a lot of private equity owners in a bind. And so whether it was, you know, we've been through stages of dividend recaps, NAV loans, continuation vehicles, and now structured equity, which, if you look at the Apollo Hybrid Solutions Group, I was looking at a stat in that story, they have deployed 3 times the amount of capital from that group this year relative to last year. Tells you there's a lot more demand to structure these tools. And when you talk about structured equity, that's at somewhere between common equity and your debt-like instruments, so you're not really giving up control, but it is expensive capital. It makes life hard for the owners.
Quick question on that. Is that something that would also annoy other people in the capital stack, to say, like, you're inserting this mechanism that kind of falls higher in the pecking order when you have a company that maybe needs that money?
Completely depends where you're in the capital stack. So if you're a common stockholder, yes, it'll completely annoy you because you've added another layer in front of you, and so you better hope that this company goes well, continues to improve, and when they finally exit this, it actually exits in a much better shape, because adding a new entity ahead of you is never a fun thing. You want that extra cushion behind you, not obstacle in front of you.
And to your point earlier, so are LPs actually getting their cash back, or are they given more and more creative reasons to believe that maybe they are?
That's an interesting question, because it depends on how you slice and dice it. Because if you look at the raw figures, if you look at the statistics, if you look at the DPI number, that number has been going down. It is nowhere near where it should be, and that is why LPs are getting frustrated. So it is going to take time, but at the same time, the private equity owners are responding to it by finding some of these new structures and inserting these new structures into their deals, into their portfolio companies, to find quicker and easier ways to return that capital. So some money is going out, perhaps not enough, while at the same time causing other structural issues. Are
people still wearing, like, the DPI is the new IRR shirts? Have they put those away? You saw that reporting, right? That, like, at annual general meeting, someone came with a shirt that said that?
Luckily, my TikTok and Instagram algorithm is all about mountain hikes, and I'd like to stick to that.
Wow, so zen. Our algorithms are sending us very different things.
I'm shocked you even have TikTok. I will follow you.
I might have lied there.
Mine's all just like how AI is taking over the world. Anyway, Shri, thank you very much for joining us. Appreciate your time. That is Bloomberg Shri Natarajan, and a really fantastic big take from the team. Highly recommend everyone go out and read that this morning. Still ahead, Bloomberg's Lisa Abramowitz sits down with United Airlines CEO Scott Kirby on 10 new destinations across Europe and Asia. That conversation coming up. This is Bloomberg Open Interest. You're watching Open Interest, almost an hour into your trading day. Let's get a check on your equity market. And it is a rally as NASDAQ outperforms, up 0.5%. The Russell also doing okay this morning as bond yields come in. We are down by 4 basis points. Isabel, it is being aided by Brent crude, which is now below $89 a barrel, despite the warnings out there from Druckenmiller and others.
I know. Actually, Ed Yardeni had a great note this morning. He said that he argued that Bessent's buyback plan probably wouldn't be necessary if the Fed raised rates last month. So again, everyone's just trying to conjecture and to analyze this whole thing. But it hasn't helped the volatility. And to your point, it made a round trip back yields.
Well, it is this awkwardness of Chair Warsh saying that the bond market is doing the work for us by having higher yields, that it's a fundamental reason it's pricing that and it's helping constrain some of the funding costs. And then at the same time, Treasury Secretary Scott Bessent saying this is not fundamental and it's something we need to push back against.
And you juxtapose that with Kevin Warsh, who wants to be as hands-off as possible when it comes to markets, in contrast to Scott Bessent, who is intervening.
That is launched all-out war against the bond vigilantes. Coming up, we're going to talk about United. Those shares are rallying this morning. It's added 10 new destinations in Europe and Asia with a new fleet of Airbus jets. We're going to hear from the CEO coming up next. This is Bloomberg.
United Airlines announces its largest international expansion in company history. The company's CEO, Scott Kirby, sat down with Bloomberg Surveillance co-host Lisa Abramowitz. Take a listen.
What we've realized is, as we built a brand loyal airline at United that customers love and that customers want to fly, it allows us to open up new destinations to Americans around the globe. And it's been really successful. It's an exciting day for us. 10 new destinations around the globe in a single day. I don't think any airline in history has done something like that. And it's going to be a great summer ahead for our customers and our employees next year.
In the past 5 years or so, there has been this huge expansion in the total revenue that United derives from international relative to domestic. Do you expect that to be the path of travel going forward? That will continue?
Yeah, I think our growth rate internationally is going to be, significantly higher than domestic. We have great hubs for it. We were born on third base for international expansion. Newark is a phenomenal hub. It's the best hub for flying across the Atlantic. And now that the FAA, has really taken steps with slot controls and staffing, Newark is now the most reliable of the 3 New York airports. First time that I know of that's happened. It really enables this kind of expansion.
Regardless of traffic patterns, you're still trying to expand at JFK. And I have to say that trying to get out there these days with the traffic is a notable feat. But you are planning to continue the expansion there with the JetBlue partnership. And even beyond that, how's that going? Kind of where are you in the process of that?
We get our slots next year to get back into JFK. It'll probably be the second half of the year. We've got aircraft delivery delays also, so we have to wait for Airbus to get the deliveries in time to have lie-flat seats on all those aircraft. But we're excited to get back into JFK and fly the transcon markets sometime next year.
Last time we spoke, you have been talking about the resilience of the U.S. consumer and how much people have adjusted, continued to want to fly premium. That's been one of the fastest growing areas for the network. Has that continued, or have you seen any shift in that? Yeah,
demand is strong really across the board. From premium all the way to basic economy. We really haven't seen any cracks in demand. And the economy, every time I talk to you, I say the economy is held up better than the pundits would have thought, and even than I would have thought, given everything that's happening in the world. But consumer demand is really strong. We are a very good real-time indicator of what's happening with the economy and how people feel about the economy. And demand is strong. I looked at the bookings for this morning. Demand is strong all the way through yesterday.
So if you put your economist hat on, do you have a sense of, or how would you characterize things? Are things heating up? Are they slowing down? Are they staying at sort of a stable, strong level?
I'd call it stable. I think the economy is not, I really don't see any places of weakness.
That was United CEO Scott Kirby with Bloomberg's Lisa Abramowitz. And Isabel, I feel like it does just lead to this overall idea about United, that they benefit when they target the luxury flyer.
Yeah.
And if they're expanding internationally, not only are they confident that that can continue, but it just increases their exposure to that specific cohort, too.
And I think they call this as secondary cities, like popular tourist spots that may not be the immediate first on your mind. It's not the Paris and others, but then they're interesting, and they're places that no other U.S. airline ever travels to.
I've been thinking about this a lot recently, of just how much wealth is being created right now with, like, all of the VC, all the AI money. And so, like, yeah. Why not have a direct route from Newark to Ibiza? Like,
or
why not?
Yeah,
yes,
why
there are
not?
all these people who just are seeing this wealth be created either because it's AI or because we're in the midst of this silver tsunami. And so it's like not just the fact that it's a K shape, but the upper tier of the K is quite young right now. And this is the exact kind of travel that they likely would want to do.
That is true, because I was going to say it's just it's an interesting dichotomy, because then we also hear about retailers and how the consumer is squeezed. But on the other hand, sure, let's travel business class to Ibiza or Ibiza.
Oh, yes, of course.
Ibiza.
Say it correctly. So you have that on one hand. And then you make a really good point to contrast it with Dick's Sporting Goods this morning. Yeah. To look at Foot Locker do so poorly. But you asked a really interesting question to Lindsay Dutch. Like, is this just a consumer who doesn't want to buy $150 sneakers? Because the consumer will buy luxury. They've just gotten more discerning, and they're just not buying everything at this moment.
I think the word in one of the things I read earlier was choosy. They become choosier. Why not? You and I deserve to be choosy. Everyone deserves to be choosy.
So what? So you're telling me you're wearing $150 shoes right now?
I'm not wearing $150 shoes, but let's try to buy business class to Marseille. Is that the correct pronunciation?
Yeah. I think, or, you know, we find a business justification to be out there. I'm sure there's some good interviews in Marseille. Open interest in the road in Ibiza and Marseille. As well, let's get a check on markets this morning. We are an hour into your trading day so far. Look at the Nasdaq. I mean, it is up 0.5%, a big rebound from what happened with AI yesterday. But how much of this, Isabel, is just going to be sitting on hands, waiting for Nvidia, which is going to be reporting earnings in just over 24 hours' time? A big risk event for this market.
Definitely a big risk event. You asked one of our guests earlier, and they said Nvidia is key. And then you also have said probably 4 times in the show that it broke a 6-day losing streak, or was it a 7-day?
7-day losing streak. Wow, I said it 6 times, and you still can't remember me, Isabel? I'm just kidding.
You need to say it 8 times for me to remember. But yes, it's really an interesting market. I mean, you're seeing stocks rising, declining oil prices, and bond yields. I think it's just a wait and see for Nvidia and Jackson Hole.
It is, and there's this question about financing. To your point, yields are moving higher, or at least they're steady at a high level. The CDS spreads for Broadcom have blown out. So will Nvidia snap what has been, I'll say for 7th session losing streak, its longest since 2022. So, Isabel, we will get those quarterly results after the close tomorrow. What else are you looking at in terms of single name movers?
There's also Zoom and Intuit. They report earnings after the bell today, Dani, and this is again a test for the software space that has been heavily scrutinized by the rise of AI. So we'll also get Salesforce and CrowdStrike earnings this week, and you see the stock there both down in the red by more than maybe 1.5% to 2.5%.
And it's definitely not a good sign that Thoma Bravo, the giant and private equity software names, is starting to have more concessions when it goes to its lenders to try to find debt. We should probably get a check on crypto stocks after Bitcoin touched $80,000 for the first time since May. Isabel, the debasement trade, it's back, baby.
It's definitely back, Dani, and this is the concept that maybe because the fiat currency is weakening, fine, pile into gold and pile into others. And of course, pile into Bitcoin, or as Tom Keene would say, BitDog.
The problem isn't just what the Treasury doing, it's what Iran is doing. What the U.S. is doing to try to combat Iran, too, with economic warfare.
That's an ever-changing headline and ever-developing. And coming up, we have the U.S. ramping up economic pressure on Iran.
America is no longer managing the Iranian threat. We are ending it. Every country, every entity should know that they should be prepared to face U.S. sanctions. No one is above this. We are going to hold everyone accountable, and this is economic asphyxiation of this regime.
That was U.S. Treasury Secretary Scott Bessent speaking yesterday. The U.S. is ramping up its economic pressure on Iran, warning that countries doing business with Tehran could face sanctions. Let's get more with Bloomberg Washington correspondent Tyler Kendall, who is at the White House. Tyler, we have this speech yesterday, and the price of oil drops precipitously today. New York Times also reporting that the U.S. is sending diplomats back to the Middle East. Taken as a whole, are we getting a picture at which the U.S. has zero interest in re-engaging with kinetic warfare with Iran?
Well, Dani, at this point, the White House has made pretty clear that they need to do something to get Iran back to the negotiating table. And officials have been pretty open that they want to opt for this economic pressure, the economic squeeze, instead of restarting full-scale military operations. Now, privately, and our own reporting has indicated that there's various reasons for choosing this path, including one when it comes to the idea that the U.S. needs to replenish stockpiles back up first, and questions about what the risk versus reward would ultimately look like. But the administration is making clear that this is a threat, and according to the Treasury Secretary, it is something that they are giving individual countries specific timelines to follow through on, or they will face this so-called secondary sanctions risk. You just saw it right there. There are a range of sectors here that the U.S. is going to be zeroing in on when it comes to technology, digital assets, as well as gold, aviation, and shipping. So there's a few different threads that we have to watch. But of course, Dani, importantly, is what is going to happen when it comes to whether or not China is going to heed this warning from the U.S. I have to say here in Washington, the sense from talking to people is that the administration doesn't think that China is going to go so far as to completely cut off financial ties, but maybe there could be some sort of action ahead of Chinese President Xi Jinping visiting here to the White House, such as potentially reducing those imports of Iranian crude.
That's a great point, Tyler, because what does happen if China or India or a major trading partner refuses to comply?
So at this point, the Treasury Secretary says that they could face the so-called secondary sanctions risks. He did outline a few other different ways that the U.S. Could go about this, but we're really waiting for what those firm details are going to look like. But he said that these countries could be even cut off from the U.S. financial system. There's going to be a range of ways that the Treasury is going to be monitoring this, according to the Treasury Secretary, and they are already taking action, apparently. It's already sanctioning at least 60 entities, vessels, and individuals, and maybe by the end of this week, we could see a major financial institution sanctioned as well. At this point, the U.S. is saying that they are going to put all of their resources into making sure that there is compliance. Isabel, we heard the Treasury Secretary himself say that President Trump is making calls, but that this is extending beyond his department to also those in the U.S. military and the State Department, too.
Even so, Tyler, there seemed to be a really telling moment after a reporter in the room basically said, why not apply this now? Why give people the opportunity to make reforms rather than enforcing this now? And Secretary Bessent said, why would I want to blow up the global financial system? Is there a degree, especially as we await a meeting between Beijing and Washington, that this is yet another negotiating posture from the White House?
He did seem to acknowledge the risk of acting too aggressively. He said, Dani, that he wants to give trading partners time to correct bad policy, and alluded to the fact that there could be some pretty big economic upheaval here. Of course, we are waiting for this visit now, less than a month away from the Chinese President Xi Jinping here to Washington. And there are so many issues on the table that the U.S. still needs to address, including the administration's desire, according to people familiar with the matter, to extend that trade truce that is in place and set to expire by November 10th, with questions lingering about whether or not we will see a fourth meeting between the two leaders before then or after then, as this White House has previously laid out. It is very clear, though, that the U.S. wants to see some sort of push when it comes to the diplomatic front as we get closer and closer to the midterms. In the last week, we've gotten different reports that various mediators, including from Qatar and Pakistan, have traveled to Iran for an update on negotiations, but they haven't really yielded anything tangible. And if at all, this morning we're getting new escalation from President Trump, posting on Truth Social a few moments ago, warning Iran against laying mines in the Strait of Hormuz, after previously saying last week that the U.S. had done the work to clear and detonate all of them, giving us a glimpse into some of the insight that the White House is dealing with when it comes to the threats that still remain to commercial shipping.
We also have another headline we're keeping an eye on, Tyler. Canada's government will announce measures on Tuesday to protect and support its workers in response to the U.S. tariffs. What is the latest on that?
Well, Isabel, actually, I mentioned President Trump is posting on Truth Social about Iran. More so this morning, he is posting about the conflict, the trade conflict with Canada. We got a flurry of posts from him, including within the last hour, saying, quote, I deal with many countries, and Canada is easily the most difficult and unreasonable, keeping in mind that our own reporting from Canadian officials is indicating that the U.S. wasn't giving enough concessions for Canada to ultimately agree to this trade deal. Different sides, different stories from different sides. We'll see where it shakes out. At this point, we haven't gotten an update about negotiations. There seems to be a leeway here since President Trump's latest specific tariff threat of 50% on autos wouldn't go into effect until January 1st. But there is the threat of escalation on the table. And we're waiting for a press conference within the next hour from Canadian officials outlining what the retaliation against U.S. goods will look like. Isabel and Danny, we're watching closely how it will impact specific U.S. sectors such as steel and dairy that Canada has already outlined that they're going to put levies on.
Tyler, thank you so much for your reporting. That is Bloomberg's Tyler Kendall live from the White House. Coming up on the show, smart ring maker Oura is reportedly seeking to raise up to $3 billion in an IPO. We'll get the details coming up next. This is Open Interest. This market waiting for a lot of big IPOs. We might get any day now Anthropic filing its S1 in order to go public. Oura Ring, another company, it looks like we will be getting public as well. And in the midst of all of this frenzy, Goldman's co-head of investment banking, Matt McClure, says, no surprise, the IPO market is open for business. He sat down with me last week on Bloomberg Deals.
It may well be that some of our pipeline, depending on how the markets evolve for the rest of the year, slips into 2027. But I think the important point really is that the direction of travel is a positive one. And there's no question that the IPO market, I think, has continued to see incremental growth versus last year.
So some potential headwinds, maybe volatility, geopolitics you mentioned are always one. We're also in a midterm year that's coming up quickly upon us. What are conversations with clients like ahead of midterms? Are people trying to get in front of them, get M&A done before things come less uncertain? Is it not registering?
Yeah.
How's that factoring in?
Our corporate clients are much more focused on delivering long-term shareholder value. And if an acquisition is really a strategic priority, they're not going to be trying to game that around the timing of the elections. They're focused on investing for the long term. So the fundamentals that are really driving their decisions are really around attractiveness of the candidate, the macro backdrop, what does their funding cost look like, and how confident are they feeling in their business performance? Those are really the drivers around deciding to deploy capital. Now, obviously, if we get through the midterms and there's a sea change in sentiment that weighs on CEO confidence, then clearly that could have a dampening effect. But the dialogue we're having with clients at the moment is not really focusing on the midterms.
I just want to be clear to anyone watching, attractiveness of the candidate of the company they want to take over, not the politician.
Exactly. I'm not making any political judgment on either party.
Just trying to save you, Matt. Just trying to make that abundantly clear. Of course. We are, though, seeing, so the regulatory environment has been somewhat friendly, but a strange thing has happened where the states are getting a lot more involved. We've seen this in the Paramount deal, too. How often is that a conversation with clients of now you need to think not just about federal regulators, but how states will pursue these?
Yeah, it's a great question. And I do think, and this isn't unique to this particular period in time, but the sort of regulatory overlay on M&A, particularly around more consequential transactions, it's super important to be doing your work up front, and not just at the federal but the state level, to make sure that you've thought through all of the potential angles, because obviously that can have real implications for the probability of closing a transaction.
Goldman co-head of investment banking Matt McClure speaking to me about the environment for deal making. So as I mentioned, smart ring maker Oura, the latest company looking to tap a resurging IPO market, seeking to raise as much as $3 billion in a U.S. listing. Bloomberg senior reporter Bailey Lipschultz joins us now. Again, it feels like just another important marker that it's not necessarily the trillion-dollar companies that feel comfortable IPOs. It's the $3 billion ones as well, Bailey.
We have a couple of them. We reported that Nscale wants to raise $3 billion. So these are two deals that are expected to try to beat Anthropic to the market. So they should be filing publicly then in the next week or so. The big question, though, comes back to valuation, kind of how these companies fit into it. Oura, interestingly enough, again, health tech very much in vogue right now in terms of the consumer, trying to shift away from eating fast food, tracking things like sleep, does stand kind of opposite of the AI pitch that we've been seeing where investors are piling into AI infrastructure. So interestingly enough, kind of a contrasting deal relative to that Anthropic IPO.
How do you sell, though, Bailey, a $16 billion valuation when investors are also asked to look past a device that is alleged to be overstating what it can measure. I just asked Dani, why don't you have an Oura as a fit person? I really said that as a fit person.
Yeah, it's so kind of you. So kind of you. No, I mean, I think it's a good question of well, consumers keep buying this stuff, and they have the valuation that Isabel has been underpinning.
No, exactly. And these are rings that are in the hundreds of dollars. So people compare it to a Fitbit, which we know how that played out. Obviously, there's a discussion, not only to your point, of that lawsuit that maybe they don't track sleep as properly or as efficiently as they should. Company kind of had a statement standing opposite of that. But the big question does come back to valuation. Is this something that people are going to buy an Oura ring, want to upgrade in the next year or two, and continue to pay that monthly subscription? So it's a big ask. The numbers, according to some of the bankers and investors I know around the deal, have said the numbers look great. Those aren't public yet. So the big question will be when they do hit the road, when they are formally marketing this deal, what valuation investors want to ascribe. And as we had reported, secondary is going to be a big component of this deal. Normally, that is either something you see in big PE deals, not the case, or potentially seen as investors trying to cash out just a little bit at the IPO, which will be interesting to track.
I also don't think until the team's reporting, I fully appreciated that this was a Finnish company.
Yeah.
Do you think Europe is looking at this and saying, another one, not another one, we've lost the U.S. IPO market?
Nscale, another one, a Greco filing yesterday in the UK base. It is really kind of a sign of the times, even more so, that these European companies, whether their roots are in Europe or their headquarters are still there, choosing to list here in the U.S. Because I do think if you spoke to European investors, London investors, the question would be, well, what are we going to compare Oura to? Whereas here in the U.S., probably better comps, trading higher, better valuation, investors more willing to kind of look past an expensive ring with a subscription relative to what we see typically in Europe.
What does the valuation tell you about how Wall Street values AI-powered consumer health products? Like, what if it was just a consumer health product? I mean, do you think it would have gotten the same?
Well, it's still a targeted valuation, so we still need to see how this deal plays out. We've a number of times seen targets be woefully short and also seen companies surpass those ambitions. The big question, again, back to a $16 billion valuation, is what is the pitch in the long run? Is it strictly going to be tapping into new markets? Because when you compare it to Whoop, Whoop seems to be more of a male-dominated product, whereas Oura is female-dominated.
I haven't thought about that before, but Whoop is trying to offer fancier leather bracelets, maybe try to get women in there.
And the difference, too, is, at least when I was in San Francisco last week talking to some of these people about these deals, was Oura a very expensive device, call it $500, $6 a month cost. Whoop is closer to a $30 a month process. So kind of the back and forth, but obviously everyone in the Silicon Valley has one, if not both.
I was just telling Dani the jackets they put on the Oura ring. But I guess you're right. It's targeted more for females?
Yeah, definitely so. Everyone's tracking themselves and I guess needs to know how much they've slept. Bailey, thank you so much for joining us. Appreciate it. That's Bloomberg's Bailey Lipschultz. And of course, catch Bloomberg Deals tomorrow at 12 p.m. New York time. That about wraps it up for Open Interest this morning. Isabel, thank you so much for joining.
Always a pleasure, Dani. You're the best.
You're the best. Such a joy to have you. And on tomorrow's show, we're going to have PNC CIO Amanda Agati, Katie Kaminsky of Alpha Simplex, and Vijay Rakesh of Mizuho. You're watching Bloomberg TV.